This is a soul-searching episode. The fund is down 46.8% for the year. When I talk about volatility and you gotta embrace volatility, this is what I mean. It's easy to talk about all these things when you're up 200, 300%, when your CAGR over 13 years is 20%. That CAGR is much lower now. We haven't done the calculations for the second quarter yet. As of the first quarter, we're still up almost 20%, but clearly this drawdown has happened afterwards. So it's a lot. That's why we're doing a soul searching episode now, because the purpose of this podcast is to give people a sense of what it feels like to run a hedge fund. Well, this is how it feels like to run a hedge fund. You're down 46.8%. You feel depleted. You feel like a failure. You let your customers down. It's bad. And yes, I've spoken many, many times about the fact that we have to embrace volatility. Volatility is part of the game. It is the game. Excuse me, it's not just part of the game, it is the game. Why is volatility the game? Well, there's two reasons. One is the natural Sharpe ratio, which is the actual, let's say, natural way a company progresses. And assuming we invest in companies, we have projects, we have iteration, we have mistakes, errors are made. That's volatility. And then there's error correction, the cost of error correction. We've spoken about this natural Sharpe ratio, which is really what we try to invest in. You want to have maximum iteration at the lowest possible cost. This is the optimization problem that companies like Tesla and our CRISPR companies, all our portfolio companies are exposed to. This is, of course, driven by fundamentally new concepts, engineering practices, and that's how you iterate, and you have to find ways to iterate faster, which is you have to use computation, because computation is just another way to iterate. And if you can do this at least at the speed of Moore's law, if not even faster, then things hopefully can turn out into a wealth creation process. This is what we're investing in. And the reason we have volatility is because people can make mistakes. But the volatility we have right now is driven by the market. What I mean with that is it's driven by macro environments, by leverage. Let's say somebody last Friday probably has been liquidated or had to liquidate quite a chunk of shares in Tesla. It could be that third largest shareholder, the person from Indonesia, I forgot his name. It doesn't matter. There's for sure there's a lot of leverage in the Tesla stock, in almost all growth stocks, and that leverage is being sucked out of the market. So let's talk about all these things. Let's talk about the volatility in the companies, and then the volatilities in the market, and why we're exposed to this, and how we think this is going to pan out in the next 1 to 2 years. Not even the wrong podcast. It's May 21st, 2022. This is Krim Delco. For the year, the fund is down 46.8%. The market's down 19.1%. We're underperforming by 27.7%. So let's start with Tesla, and then we'll talk about the CRISPR companies and also Bitcoin. Our position right now is the following. We have Tesla, which is roughly 100% of NAV, and then there's the CRISPR stocks, about 5%, and there's Bitcoin, about 5%. Maybe I'm a bit wrong on that. So this is kind of the situation where we live right now. What we've done in the past week is reduced our leverage. We keep our leverage at a certain percentage, and because of the drawdown, we've been reducing our leverage. So this is one of the things we've been telegraphing in the last couple of days. And just as a side note, if you have leverage, you have to manage that leverage, and that means having leverage is kind of like being short volatility, which is, unfortunately, you have to sell at the wrong time. And this is what we're doing right now. So we're not selling because we have less conviction or anything like that. It's just simply we have to manage our leverage. So this is one thing we've done. But let's talk about Tesla now, and then we'll talk about Biotech and Bitcoin also. Again, these are smaller positions. The Tesla position is the large one. So this is really what we're focused on. So what's happening with Tesla? Let's talk about the company, and then we'll talk about also the stock, which are two different things. So the company is, like we've said many times, the fundamentals have never been as strong as they are today. The reason for that is that decarbonizing the future of the world is what basically Tesla wants to do. And it happens just that the world is also jumping on that bandwagon. So without going too much into detail, I think it's almost self-explanatory that the demand for products and services that Tesla can deliver is growing. It's growing across the whole portfolio of products, from cars to batteries to solar. And because the demand is so strong, we believe that fundamentals are strong. Now, one caveat here is that the big risk of Tesla right now is China. And the problem with China is that Tesla is not able to produce cars. So when I say the fundamentals are strong, I'm a little bit biased on the demand side. And that's a mistake, but it is just kind of, how should I say, it is a little bit anecdotal in a sense that that's what people on Wall Street generally do. When they talk about fundamentals, they talk about the demand side of things. Like, this company has strong fundamentals, which means in plain English, people want their products and services. Now, of course, you can also be in a position where you just can't produce it. And there's companies that can't produce products and services for various reasons. In the case of Tesla, it's because there's force majeure. Force majeure, China is doing things that are supposed to protect their population from COVID. That's certainly not under control of the Chinese, and it's certainly not under control of Tesla. That's why it's force majeure. Now, having said that, of course, we have to think about this as investors. And for us as investors, in the end, it really doesn't matter why you can't produce something. If you have a car that people want and you can't produce it, then you don't have the car. And in many cases, by the way, the competition of Tesla is in a similar position, but not because of force majeure, it's because they just can't do the car. So let's say when Ford tells me we have a lot of demand for our car, or Lucid or Rivian, well, the demand is strong because you're mispricing the car, or even sometimes mislabeling and mispricing the car. So those are very bad things. And that's a real fundamental problem. Now, again, I don't want to diminish the fundamental problem that Tesla is in with China, because not being able to produce cars is not being able to produce cars. And maybe you could say, well, you shouldn't have built that factory, you shouldn't have projected 50% growth, because you can't. And I have to say, as an investor, in the end, it doesn't matter why things happen. When they happen, they're bad or good. In this case, they're bad. So this is a long way to say that fundamentals aren't that strong, unfortunately. And that was a mistake on my side when I said the fundamentals are as strong as they've ever been. Well, they are, but the caveat is China. If you can't produce, you can't produce. So this is the risk, the big risk. And again, we're talking about the company now, and through the lens of the natural Sharpe ratio. So the natural Sharpe ratio is, again, it is the amount of iteration a company can do divided by the amount of mistakes, and then minus the cost of error correction. And you can normalize this and put it in percentage or rates or something like that. This is not about math. I think the concept is just simply iterate as much as you can, make as little mistakes as possible, and if you make them, make sure that the cost of error correction is very low. This is what wealth-creating companies do. Now, they also have to happen to have a market for what they do. They have to happen to have a big market, big demand, all of these things, and Tesla happens to have that. That's what I meant with fundamentals are strong. But we can produce in China. So what can mitigate that? One is China gets better, hopefully. I hope it for Tesla, I hope it for China. This is terrible for the people in China. It's terrible for everybody, even for the Communist Party in China. It's going to create havoc, revolution. When people don't have to eat, when they're separated from their kids, all of these things are red flags that are not good for anybody. So hopefully they get out of this. Maybe the zero COVID policy is not the right way to go about it. It's not up to me to decide how they should run their country. But I hope this is hope that they can fix it. So this is one. We had some positive news from there. Let's say Tesla is working in a closed loop system. I think they have 2 shifts. So they can come back to some sort of production. So this is good news. What's good also is we have Texas and Berlin up and running, and keep running, and it's going well. So these are good things. So let's say what we have to live with now is a reduction of maybe production by, let's say, 200,000 cars. So 1.4, instead of 1.4, we're going to print 1.2 million cars this year, which is maybe only a growth of 20 to 30% instead of 50. That in itself is worth probably 20, 30% in the stock. The stock from the highs is down about 60%, and about 50% from the highs, 50% from the highs. Year to date, we're down about high 30s. So this is what the stock is pricing in right now, which is fair. I think it's by the way in line with Amazon. It's even better than Nvidia. It's much better than Netflix or Snowflake. So given in the context of the market, it's fine. But let's stay with the company. We're going to talk about the market in a second. Okay, let's stay with the company now. And again, I think there's a difference between the stock and the company. So we're talking about the company. So China is a risk. It can be mitigated. We believe the market is pricing that. So that's fine. And we have Austin, and we have Berlin. 4680. At least the narrative there is that the company has been able, this is now part of this natural Sharpe ratio concept, you iterate, you come up with new things. 4680 is absolutely fundamental for the future of Tesla and the car industry, because if you can build the stuff at lower cost faster, and 4680, according to Battery Day, it has the three big things, which is you have a better chemistry, you can produce it, you can produce the battery at lower cost, and then you can also integrate it into the car at lower cost. In other words, also the capital efficiency is much higher. If you can iterate much faster, produce at scale, and do much faster and bigger production, then you have a much better chance to grow, because every company in the end is constrained by its cost structure. And that's what Drew Ballino, the head of, I believe he's head of technology and science and all these things, but I don't know what his exact title is, but in my view, he is the one person that could succeed Elon Musk, at least as a CEO, or at least he could be COO, because he has that view of becoming a large company. What does it take? Well, you have to have the production, the cost structure in line. This, by the way, is an important point, because there's a chance that Musk might step down as CEO. That's something I want to talk about in a bit. Let's stay with this. So 4680 is on track, which is incredibly important. FSD, it's also, I would say that we're not going to get a quantum leap there. What we need is actually, and pun intended, maybe we need quantum machine learning. We need something to be able to go on an animated version of learning, self-supervised reinforcement learning, and then have billions and billions of iteration in an animated world, and then become a full self-driving, full-fledged self-driving solution. We're not there. We're on this sort of hybrid path where we learn from expert drivers, we learn from people that drive, we have a large network, we have the data infrastructure, we have the computer vision driven by Carpati. So all the ingredients with the current technology that is available, a state of the art, are there. We have the chip technology, the inference, and the dojo, which is the learning. So all the things are in place for what is available today. But I think to really get to full self-drive robotaxis, we need a new paradigm shift in the way this is done. And our view is that it has to happen through a different way of machine learning, and also a different way of learning in general, which is self-supervised reinforcement learning, which only can happen in the animated world. But we can have a better animated world, and this is the key, not a hard-coded animated world or video games, but an animated world much more like a la maybe DALI or something, or BERT, or one of those things, where transformers, where you learn from the existing body of available data, but then you use those transformers to build new worlds, artificial worlds, based on the existing data. So therefore, the animated world, which is built artificially, is rooted in the real world, and that's where we see a potential for an animation-driven self-supervised reinforcement learning solution for full self-driving. So the long story short, again, when it comes to the drivers, the technology drivers of Tesla, we believe that the full self-driving is certainly a big asset, but the full solution for robotaxis is not there. So this is one caveat that we have to discount that a lot. Now, even with what we have, what we really have is we have a software as a service model that solves a lot of problems for people, much better driving, much more convenient driving. Even the autopilot is much better than not having it, and the full self-drive is even better. So all of these things are monetizable today, and that's what really matters. And because there is such a strong demand for cars, Tesla can use actually the software as a driver to basically for people to jump the line in terms of waiting for the car. In other words, you can pay $12,000 more for the software, and that $12,000 can also get you faster to your Model Y, for example, which is a nice way to basically pay more to get the car faster. Having said all of that, so we're in a situation right now where we have The ingredients for scalable growth for the next couple of years are in place. We have the factories, we have the 4680 technology, and we have the software, so which is important. I think one other big ingredient is insurance. Why is insurance so important? This is borrowed from Pierre Farangu's concept. Well, the concept of insurance is the following. Insurance is first a big cost item for customers. Second, you can tie insurance into the full self-driving suite. If insurance is all about the probability of accidents, and it's probably very skewed, so this is not like fully distributed, meaning there's a few types of accidents that cost the most. If you can reduce those, you can save maybe 20, 30, 40% of insurance expenditure. And if you can do that, in other words, you can actually lower the cost, maybe not 10x, but you can lower it by 50%. If you can do that, you can then tie people into this Tesla ecosystem of you buy the car, you buy the software, use the software, you get monitored by the software that then prices in your insurance premium. And if you can go from $180 a month to maybe $100 a month, that is almost 50% savings, and that makes a difference in people's budgets. So again, this is a little bit like Apple was able to tie you into their ecosystem with all the iMessaging and FaceTime and all that, and the iCloud. This is a similar way to tie people into the Tesla ecosystem. So insurance is an important one, and I think Farangu is very right on that one. We have the chip business, which is all internal right now. That's a possibility that it becomes an AWS type business, but given the scale and the problems that Tesla is solving right now on the computation side, the compute side, which is dealing with the data that comes in, dealing with the machine learning side of things, dealing with the inference side of things. There's a lot of problems that they can solve just by themselves in order to make them more competitive. So a little bit like Walmart solved the problem of having relational databases and becoming a distributed retailer based on computer technology. In a similar way, Tesla can just become a much bigger car company based on compute alone. So in other words, we don't need AWS here to have compute as a driving factor for future monetary success. So all these things are in place, and this is important. So to summarize, what the drivers of the company are 4680, full self-drive, insurance, and the ability to scale factories fast to very large numbers. These are the drivers. We have demand. Demand is there because decarbonizing the world, also de-Russianizing the world, so getting rid of Russia as a supplier of energy products is important. And I just want to say one thing here. For what is our view on the conversation, are EVs better for the environment or not? And we had an episode about this, I think the last a few episodes ago. We spoke about this. The problem is not to save the environment, because saving the environment is a bad problem in the sense that it's not clear what the problem is, and therefore it's a bad problem to solve. I'm all for saving the environment. I just don't know what that means exactly, so I don't want to even think about it. What I want to solve is decarbonizing energy. And why do we want to decarbonize energy? And are EVs better than gasoline cars? Yes, they're better for one simple reason: they give us more optionality. EVs give us more optionality, because if our source of energy is electricity versus fossil fuels, we have a lot more ways to produce electricity than just with fossil fuels. This is the key. So it's the optionality. We increase the optionality for any society which goes electric. Take Norway, for example, or California, which is, Norway is very high percentage already, and California is getting there. We just have more options now. We can use nuclear, we can use renewables, we can use gas, coal, oil, we can use hydro. All of these sources are available to us for transportation. Versus in the fossil fuel world, there's only one, which is fossil fuel. So this is it, end of story. It increases the optionality, which is another problem that can be solved. It's a good problem. How do I increase the optionality of a country or a region or an economy or whatever unit you want to choose? How do I increase the optionality with, let's say, with technology? Well, I can introduce electric cars into the transportation infrastructure. So this is why demand is strong. Now, what are the negatives of Tesla? I think the Elon Musk situation is unfortunately becoming worse and worse. Why? Because he's more powerful, he's getting more isolated, he's putting himself in more difficult positions. The Twitter bid is just one of them. Elongate, clearly a political hit by the left against him. So all of these things, they're just going to keep piling up. Tesla, hiring a legal team, the market freaking out. Why do they need a legal team? I think it's good for Tesla to have a legal team. I think this is another foresight that Musk has, which is, look, I'm going to start. Here's why Tesla needs a legal team. It's not because of Elongate. It's not because of Twitter or whatever. If Tesla grows at the clip that they're expected to grow, they're going to start eating a lot of people's lunch. People are going to lose market share. They're not going to take it well. And the legal fight is simply there to protect yourself against misinformation, against bad allegations, and all of these other things that could come up, but it will come up for sure. If Berlin, as a factory, starts producing 1 million cars a year, which are sold in Europe, that's 1 million cars that somebody else is not going to sell. People don't take these things lightly. So what Tesla is really doing here is creating a bulldog team of, they're creating a big fence around their house, and they're hiring very, very aggressive security to make sure that nothing happens to the company. He can't be attacked and defamated and all that stuff. This is what's fundamentally happening. So it's a good thing. I think Tesla has to do it. If you're a disruptor at that scale, you have to also take into account that people will start hating you, not just hating you in a sort of philosophical way like so far. Tesla has been hated for years. We've experienced that on our own skin. We had investors walk out of our fund because we were buying Tesla shares, even though they made money with it. Even today, we have people who have made money with Tesla who still don't hate Musk and stuff. It's a psychological case study on its own. Why do people hate Tesla so much? But anyway, they hate it. Now, we're going to have real haters. The German car industry, after laying off hundreds of thousands of people because they can't sell cars anymore, they will have an issue with Tesla. So all of these things will pile up, and therefore the legal team. So we're actually, that's a good thing that Tesla is beefing up. The market's now freaking out. I think the real risks with sort of, let's call it the one-person risk of Tesla is, of course, an attack, some sort of murder attack. That would be terrible. Hopefully nothing happens there. And then, of course, also Musk's mind is going berserk, a bit like Howard Hughes. And that is a risk that we have to live with as shareholders. Now, the way out of that risk is, of course, okay, are there other people who could take over? I think Drew Balino is one of them. I'd be very comfortable with him. And Tesla has a very deep bench. They showed that with Zach Kirkhorn as CFO. So they can replace people, and they don't replace people getting, the ex-CFO or CEO of Juniper Networks or something like that, which would be nothing against Juniper Networks. But you get in these professional managers who often destroy companies. Look at Starbucks, look at, I don't know, you name it. There's so many companies that were founded by passionate entrepreneurs and then destroyed by managers. So hopefully that doesn't happen, and I think it doesn't have to happen with Tesla. So those are the sort of the risks. Again, on the technology side, 4680, full self-drive, the insurance, the chip business, they're all driving in the right direction. On the personal side, we're okay with the legal aspect of the risk going up. The legal risk has to come up because Tesla is eating other people's lunch. And then the personal risk, we have to rely on the bench of Tesla, because at some point Musk will become obsolete. He's either going to become too old, too slow, not up to the task, sort of in a Netflix way. Like, are you growing above the task? Is the task growing above you? At some point he'll get old. He will die at some point, probably. So yeah, I mean, these are all, hopefully has a succession plan for Musk in place. We haven't heard much about it, but given Musk's comments on that he doesn't like to be CEO and so on, I think it's going to come, and that's going to create some turmoil. But we've seen other companies succeed, Apple namely, in bringing in a deep bench to replace people like Steve Jobs, and it's worked very well for Apple, so it can also work for Tesla. Now, to finish the episode, let's talk a little bit about the stock. Again, the stock is different because even though the company doesn't have leverage, according to Miller-Modigliani theorem, well, the investors will have leverage. So no matter what, you will have leverage in the stock. And because we had zero interest rates, actually, Tesla and many other tech companies had a lot of leverage. Even though they themselves didn't have it, the investors put on a lot of leverage because you were able to borrow dollars at very low rates and invest it in productive assets. And this is exactly why we're suffering, why everybody's suffering right now on Wall Street, because the reversal of interest rates is driving this whole dollar carry trade out, meaning you have to liquidate assets and cover your debt. Even us, we have that same problem. It's very small, but still we have to sell assets to cover some of our leverage. So this is what's happening in the market. It's happening to us. I'm sure it's happening to others who were less prudent than us. And that's part of life in the market. And certainly something we as investors have to at least think about it. Did we make a mistake here? Because this was predictable. And the answer to did we make a mistake is not really. Because even if we had, the problem with us selling everything is also, well, okay, we could have sold everything and bought it back. That's one thing we could have done. There's some tax implications with that. But given that we're up 46%, even with the taxes, this would have been profitable. I think the one thing we didn't foresee, I guess, is the magnitude of the sell-off, which is driven by all this, like I call it, the vacuum cleaner, sucking all the dollars out of the system. But we've said that in the beginning. We keep saying that it is not assuming that this would happen because the 10-year went up to 3%, that would have been wrong. We were right on that. Even now, the 10-year is going below 3% again. We believe that there's a natural barrier for U.S. interest rates to go. The problem is China. That's the thing we didn't expect. We didn't expect irrational behavior by China, and that's what's driving down the market now, freaking out the market, because a lot of companies are either directly or indirectly dependent on the China trade. China is the second largest economy. If you shut down an economy like that, you will have repercussions. So what we have here is just a sort of a COVID 2.0. We're just not calling it like that because we here in the US, we're not under lockdowns anymore. Fortunately, we're free of all these bureaucrats, at least for now, that are telling us what to do, but the Chinese are not. And that's the problem. So we didn't make a mistake assuming that interest rates and the macro side of the US would have brought us down 46% in the fund, would have been wrong. But this on top, with China basically stopping trade, this is the problem. So we didn't anticipate that. It all circles down to China. So to summarize, the fund is down 46.8%. The main reason for that is China. And we didn't foresee that because it's irrational, it's scary, and it's still a risk. It can be mitigated. China, our portfolio can survive even without China, but it's going to be much more painful than if China gets back to their senses and gets a more productive way to get out of the COVID situation that they have there. If that happens, then we see a very fast reversal of our fortunes and also the market's fortunes. So far, we're down 46.8%, which is more than the market. It's in line with tech and growth, but hopefully we as a fund can do better than that. We haven't been able to deliver better than that, and that's on us. But having said all of that, we have a lot of conviction in the technology side of things, very good conviction in the personal side of things, with one caveat, which is, of course, that Tesla needs to start talking more about the bench. And we have, as far as the market is concerned, we're comfortable with the macro side in the US. The only risk is China. And China has shown in the last 30 years that they're able to come from poverty into the second largest economy with real success. And that gives us a lot of hope and confidence that China can actually continue on that path and become not just the second largest, but the largest economy in the world. Thank you.